This is a podcast from the Business Times.
Most Asian share indices were heading for weekly falls today as stress in global bond markets showed little sign of abating. A diplomatic deadlock in the Gulf lifted oil prices to one-month highs and kept inflation risks to the fore. Yields on US Treasuries have resumed their climb after Wednesday's surprise intervention by Treasury brought barely a day of relief from selling. Welcome to Market Focus Weekly by the Business Times. I'm Howie Lim. It's Friday, the 21st of August, 2026, and I'm joined by Gary Tan, Portfolio Manager, Intrinsic Emerging Markets Equity Team, Allspring Global Investments. Gary, thanks for your time.
Thank you for having us, Howie.
I want to start with the US government recently stepping in to buy back its own debt to calm the markets. Do you think this is a real fix for the problem, or are they just, putting a temporary bandage on a much bigger issue of national debt?
I think from our side, it's really, a stabilization tool and not a structural fix. Treasury buybacks can improve liquidity at parts of the yield curve where the Fed has relatively limited influence, but they do not change the underlying reality of rising debt issuance and fiscal deficits, which is what the US is kind of facing, like applying pressure to a wound rather than putting on stitches. We saw a similar exercise in the last administration in 2023 and a bigger form in terms of operational twists during the Great Financial Crisis. So you can see in both instances, while it can calm markets temporarily, sustained stability ultimately requires confidence in fiscal sustainability rather than just, let's call it liquidity engineering.
Okay. What about for the Joe Regular in terms of oil prices? They have spiked. It's keeping the cost of living high. Do you think central banks have misread this? Is this just a temporary bump, or do we have to just live with expensive energy, Gary?
Wow, yeah, that's something that really hits, the sentiment on the man on the street.
Mm.
So I think for our side, the base case, it's really still a supply shock and not a permanent change in the inflation regime, structurally higher energy prices. In the short term, it's really difficult to tell because of the rhetoric around like the Strait of Hormuz changes almost daily. But the reason we say why we think it's more of a supply shock is that over the longer term, there are really already plans to reduce the dependence on this Hormuz bottlenecks. You can see like the Saudi Arabia expanding their pipelines, they're finding alternative shipping routes. So if you look at it over like a 2-3 year basis, I think these solutions should help ease the structural supply concerns. So from the Asian banks' perspective, we think that the bigger risk is for Asian banks to mistake delayed inflation for permanent inflation. So we can kind of see this in the second quarter data where the growth across Asia has pretty much held out and inflation has remained within targeted ranges. But high energy costs is kind of only starting to show up now, as you rightly pointed out. In Singapore, it's seemed like towards the end of conflict, then now we are seeing the higher electricity prices. So our concern is that by the time the inflation appears in data, central banks will become more cautious about cutting rates. Central banks in countries that have room to really ease policy to help combat the slowdown. The central banks might err more on the conservative side.
On a larger level, when economies start to look shaky, right?
Yeah.
Tech stocks generally get punished. Although companies like Anthropic are seeing massive growth, do you think the market is just now adjusting to the reality of how fast AI can actually grow? Or do you think investors are starting to lose faith in this narrative altogether? Plus, we're waiting with bated breath for NVIDIA to report next week.
Yeah, and NVIDIA's results has kind of become like, the Super Bowl of the tech season. We can arguably say that probably memory is now probably more at the epicenter. But to your question, we think that the market overall still believes in the AI spending cycle. I think what they're really questioning is the payback period. At the same time, these native AI companies such as Anthropic, OpenAI, they are delivering impressive growth, but their losses are also rising rapidly at the same time. So this kind of leaves investors debating when these massive investments would translate into profit. So in short, people believe in the cycle, but they're questioning the payback. And right now, the bond yields actually matters more to how investors are looking at the AI space rather than AI headlines. The steepening of the yield curve or the longer end of the yield curve is actually stress testing the terminal values of a lot of AI investments. The reason I say that is because for AI investments, expected returns are so far in the future. And basic financial modeling is that higher yields reduce the present value of these profits. So it can create a lot of volatility in AI stocks, even if we believe that the AI spending in the near term remains intact.
So even with the economy slowing, officials at the Fed seem split. How's Kevin Walsh doing, you think? Some want to still push raising interest rates, but if they focus too hard on hitting that 2% inflation goal, don't you think they're risking a mistake that could maybe cause a recession?
Yeah, I think for Fed and to a certain extent Treasury, they tend to have like sending out fairly mixed signals. So I think in our sense is that the Fed is probably less worried about being wrong on rates and more focused in staying flexible. Like what Kevin Walsh has said is that let the markets play ball instead of playing the referee. It creates more uncertainty in the near term. But on the positive side, it also gives Fed room to really pivot quickly if the economic data does changes. So for markets, we think that the bigger issue isn't whether that prioritizes inflation, the 2% inflation or growth. It's really the volatility in longer term yields, which the Fed has relatively less influence. And actually, in this infrastructure build cycles, these rate matters more. They matters to mortgages, they matter more to infrastructure investments. And this results in long duration assets becoming more volatile. And this is actually coming the part of yield curve whereby the Fed has less control.
All right, I want to head to Japan and emerging markets in a bit. Still to come, more with Gary Tan from Allspring Global Investments in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. Gary, interest rates in Japan are hitting levels we haven't seen in decades. Is the Bank of Japan truly in control of this change, or do you think the market there is forcing them to move faster than the country can handle?
Yeah, I think the Japan falls into the bucket whereby, you have currencies or key funding sources as having yields spiking at the longer end. So our sense is that the Bank of Japan is kind of steering the process, but the bond markets is really increasing, setting the split limit of how fast this process can be achieved. And this is driven by really rising inflation expectations within Japan, high government debt, and overall the pressures we're seeing in the global bond market. Overall making it harder for the Bank of Japan to engineer a perfectly smooth normalization. And Japan really matters for investors because it is one of the world's largest exporters of capital through the yen carry trade. So higher domestic yields could encourage Japanese investors to keep more money at home, and this would impact liquidity conditions in Asia, globally, and valuations across firms. This can impact global markets and especially emerging markets.
Speaking of, earlier this week, we saw a record amount of money flowing into developing economies, even with all this talk of wars and trade tensions. Do you think this is a sign, Gary, that these countries have become stronger, more independent? Or do you think investors are just looking for a quick profit while US markets are rocky?
Well, I mean, in the equity markets, despite all this geopolitical volatility and how energy prices is going to hit emerging markets harder, emerging markets are still on track to outperform MSCI World. So what we're seeing is actually more, I see a diversification trade, not a decoupling trade. And this has happened since the start of the current US administration, where investors are increasingly looking to diverse away from concentrated US exposure. And emerging markets across asset classes has been a key beneficiary of this shift. So it's not really about investors abandoning the US investment asset class. It's more about broadening their opportunity set. And this is really driven by growing caution around absorbing large volumes of US debt issuance, including, the recent ones by the hyperscalers. Investors are increasingly attracted to EM markets where real yields remain compelling. I mean, growth is still holding up despite this geopolitical uncertainty as seen in second quarter GDP data of Singapore and most Asian countries. And corporate balance sheets are often in better shape than many people are expecting.
How are you helping your clients, though, figure out the danger that's actually built into the price of an investment? Because news is changing so quickly, the markets have been on a roller coaster this week. There's panicking one day and then, oh, boom, the next day.
I think our advice to our clients within the emerging markets asset class, equities asset class, is to stay invested and work with active managers who can take advantage of this volatility. I mean, as you rightly mentioned, like markets are increasingly reactive to news flow, but valuations and fundamentals eventually do catch up. So for active managers, this price dislocations are often areas where, alpha is generated versus like passive indexes. I think the second advice that we are kind of giving to clients is that with the way the yield curve is moving, investors need to think about diversification, not just about by country, by sector, but also by cash flow profiles. I think in periods of volatile long-term yields, companies with heavily back-end cash flows tend to sell off together, regardless of geography or sector. That's why in our intrinsic emerging market strategy, we have a very balanced portfolio of high-growth companies and businesses that generate strong cash flows today. And this is ready to help negate the impact on the volatility in the yield curve.
And that be the same across geography too, right? Just be diversified, because now there's all this buzz about energy and defense spending over in Asia, aside from tech, of course. Do you think trends are built to last, or is it just a way for investors to hide from the ups and downs of the tech market in particular?
This industrial capex build out is a strong theme that we're looking for in our portfolio. So we think for investors, it's not just a hedge against tech volatility, but a multi-year investment cycle that is really supported by the need for energy security and defense spending. Spending on energy security and defense is likely to remain structurally higher than in previous decades because the sources of geopolitical and supply chain risks has become more varied. And overall, this should drive sustained industrial investments across Asia, and companies are positioned to benefit from this cycle. But the irony, I think, to come back to our previous point, is that the industrial cycle and the AI story, it's kind of more connected than what people think because, AI is driving demand for power, driving demand for cybersecurity, orbital security, and it kind of reinforces the investments in energy and defense. So you can be diversified within sectors. You can diversify your sectors from tech, into defense and, energy names. But if the cash flow profiles of the companies that you're diversifying into is similar, whereby, their cash flows have a long-term duration, you're coming down to the same effect whereby, these long-term duration companies will see valuation drawdowns when we see volatility at the long end of the yield curve. There's a need for diversification, but bottom-up selectivity still matters in generating performance.
Thanks so much, Gary, for your insights today. You've given us lots to think about.
Thank you for having us. Overall, I think investors remain broadly constructive on growth and, the investment trends that you mentioned. But higher, longer-term bond yields are forcing a reassessment on how these future earnings from AI, infrastructure, energy are worth today. So for emerging market, it creates volatility, but at the same time, it creates opportunities as global investors increasingly diversify beyond traditional US-centric assets.
Gary Tan, Portfolio Manager, Intrinsic Emerging Markets Equity Team, Allspring Global Investments. If you have questions or feedback, drop us a note at btpodcasts@sph.com.sg. And for the latest, tune into Lens on Daily, Monday morning at 10 a.m. This has been Market Focus Weekly by the Business Times. Till next Friday, I'm Howie Lim.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.